Welcome back to the BDSM live show. We're talking budgeting, debt savings, and all things money. Just a quick sound check. If you guys can hear me, do you mind just typing it into the chat box? Also gives a chance for some of the others to make it into the room that haven't quite made it just yet. And while that's happening, I'm sure that you people hear me. So this show, thank you, Hannah. This show is part of a larger B project that we're working on internally, and we're getting close to our first part of launching. Wonderful humans at open markets are buzzing around, getting ready to deliver the bee honey. Welcome to another BDSM show. I'm your host, Ivan. All advice today, if any, is general only. Today's guest is James Claridge, CEO and co-founder of Investfit. Welcome to the show, mate.
Thanks, Ivan. Great to be here, and thanks for having me on the show. Looking forward to today.
Yeah, awesome. Look, so 5 years ago, James and I were sort of in the fintech's version of college roommates, like a fraternity startup in that hub. Many years later, fate brought us together again through a common shareholder in both of our businesses, which is a large fund that specializes in early stage investments. Now, your background, James, is an actuary. You started out as an actuary. I think you still have some serious credentials in that space, and then you were working in life insurance and superannuation, then general insurance, risk management. I think your profile covers the whole thing. And then you decided to start at Investfit, and the basis was that financial advice shouldn't be a coin toss. Tell me about Investfit.
All right, thanks, Ivan. So actually, the origin of Investfit came out of another product that we were building whilst we were at Stone and Chalk. So many years ago, and that product was in principle the same, and that's why Investfit arose, and that's actually a business tool, and the idea there was that in order to make good decisions about your finance, you're modeling holistically, and you're accounting for all the variabilities that go on. Some of those are things you can control to some extent, so levers that management can pull, for example, spend more money on advertising, spend more money on sales staff, so on, and others are things that are beyond your control, such as interest rates, exchange rates, commodity prices, weather, you name it, economic factors, and so on and so forth. And our view was that to properly manage risk and to actually make optimal decisions, you need to model all of those and understand, which ones are important and how to optimize those. And we built this tool, and then a friend of ours said, "Oh, that's really cool. Why don't you apply the same principle to an individual? They also have cash flows and balance sheets effectively, and they have goals and they have things they want to achieve, so why not do the same modeling for an individual?" And at first we said, "Oh no, it just sounds too hard, not so sure," and then we decided to give it a go, and so Investfit was born. And so it is a tool to model an individual's financial future, allowing for those variabilities that go on, the key one being a variability in investment outcomes.
It's an awesome tool. So you come in, you put a couple of scenarios in, and then it effectively brings up like an asset allocation. Obviously, seen a fair bit. By the way, we've got a couple of people saying frozen screen, no sound. So I think we've got some issues on the tech. Just confirmation. If anyone can actually see us or hear us, let us know. Otherwise, we may have to figure out what to do. But while that is going on, assuming we don't have to reschedule this, tell me something. So when you go in, that whole capability around that asset allocation is, that's pretty powerful stuff. Yeah,
look, it is, and so one of the key decisions that any person makes with regards to their financial future, whether you're an individual just investing for a portfolio that you're trying to optimize at some point in time, or you're trying to invest for your whole future, being a superannuation and other investments, one of the key decisions you can make is how to invest those funds, and whether that's at the asset class level or at the individual stock level, you want to make sure you're investing optimally. And by that, what we mean is that the return or the income you're going to generate from those investments is commensurate with the level of variability you're going to expect from those investments, or risk as it's often called. One of the key things that, one of the key points that we like to make is that historically, fund managers, when they look at that return and risk trade-off that we as individuals also have to make, but fund managers typically will look at, the annual standard deviation of returns as a measure of risk. So that the annual variability in returns, obviously on that basis, shares are risky. They have a high standard deviation. You might get minus 10% this year, plus 12% next year, and so on and so forth. That is true, and that's a good measure if you're investing for a 1-year time horizon. But if in fact you're investing, you've got a portfolio and you want to optimize its value in 10 years time, or you say you've got your super, which you are not even going to touch till you retire in 25 years time, then you should be looking at a 25-year time horizon or a 10-year time horizon. And then when you look at the variability in returns compound returns over 10 years, it's nowhere near as variable as 1 year for shares. Because yes, you've had ups and downs, but they cancel each other, and in the long term, shares perform at 7, 8, 9, 10% per annum average over a long period of time. And if you're investing for a long time, then really what the value of investments is between now and then doesn't matter very much. If you can't touch your super until you're 60 and you're currently 40, that's 20 years you can't touch it. It might give you the hippity-jippities. You might get a bit upset from time to time. You look at the value and go, oh my goodness, my super went backwards this year. But if you'll think about it rationally, you go, that doesn't matter. What matters is the value when I get to age 60 when I retire. That's what matters. And so if I'm sitting here at 40, I should be looking at the compound return over 20 years, and that's my measure of risk. How variable is that going to be? Not what's going to happen next year, because it doesn't matter. I can't sell anyway or buy. It's just my super sits there and I add more to it over the years. But if it goes down this year, so it goes down. It goes up 2 years later. That's what happens. So people are being fed the wrong measure of risk in many instances. They're being fed a short-term volatility measure, whereas in fact they should be looking at the average over their investment time horizon.
And you've actually showed me these numbers a little while back, where you've done some of this research around, sort of that longer-term horizon, and how that compares to, say, cash rates. And I know we've done something not too dissimilar as well internally. That's a really impressive measure of how stock portfolios actually don't have that much volatility over a long period of time.
Totally, Ivan, and that's a really good example, that particular series of charts. So what it does, I'll just explain very briefly. It go back to as far back as we can go on the Australian ASX 200 / All Ords, tracking the rolling returns, and we do it on a 12-month basis, on a 5-year basis, a 10-year basis, a 20-year basis. And obviously, when you look at the 12-month basis, yeah, sure, you've got the cash rates, term deposit rates have been relatively stable over the last 30, 40 years, and it's a nice stable line, coming down over time. As we know, rates have come down. But the rolling 12-month share performance has gone up and down like a yo-yo, highlighting a point that if your time horizon's 1 year, then yeah, shares are really risky if you're a 1-year time horizon. Go to the 5-year, and already the line showing the average 5-year compound average annual return is still going up and down. It's wobbling around a little bit, but nothing like the 1 year, and it's only dips below the cash return over the same 5 years on a few occasions in that whole history. Get to 10-year, and it barely, I think it's dipped below once and only marginally below. 20 years, it's never been below. You've never underperformed on shares over any 20-year period for the data that we have on Australian equities. And the margin is about 5%. That's the risk premium, as we call it in the investment markets, around 5 to 5.5%. That's the excess return you make between Aussie equities and cash. And it's been consistent over the whole history that we have, going back to the 1970s.
Yeah, wow. But
importantly, it never goes below. It's a nice steady gap the whole way. So if your time horizon is 20 years, then actually cash is the riskier of the two investments, because you will go backwards with inflation. Whereas with shares, you will go forwards, and historically, you've never ever been worse off in shares than cash over that 20-year time horizon. Yeah. Now, obviously, as individuals, we have a range of time horizons. We might be pulling money out in 2 years' time from some of our investments, some of it from 5, some of it in 20 years' time when we retire. So we need to model all of those and find out what portfolio. So it's a combination. It's not just shares. It's a balanced portfolio. But the same would apply to individual securities, individual stocks. You want to come up with an optimal portfolio for you. You want to make sure it's diversified. You want to make sure you're managing the volatility over the time frame that matters to you. not just the annual. If you're looking at a 5-year time horizon, you want to optimize that portfolio of stocks over a 5-year time horizon. Investment shows you how to do that.
We'll talk about Investfit in a second. We're running a poll right now. How many of you consider having an investment strategy in place? 66% said yes, 33% said no. Peter asked, I'm 77 years of age. How do I invest in shares?
How do you invest in shares if you're 77 years of age? Well, I think, as you will know, Ivan, there's countless ways you can invest in shares. Obviously, if you have some super, you could certainly make sure some of that is allocated to shares. Most super funds will allow you to change your asset allocation, and some will allow you to pick individual sectors. Obviously, there's plenty of platforms out there, such as open markets and a whole bunch of other platforms that will enable you to invest in ETFs. That's an excellent way of investing in shares. A nice diversified portfolio, or you can try and buy shares directly yourself. That comes with costs, and you then need to construct your own portfolio, and you need to make sure you're well diversified. You're going to hear me say diversified a lot, and I'm sure, Ivan, you're the same. It's an important factor in our investment policy strategy, no matter what class we're looking at or asset classes. You need to be diversified, because if you're not diversified, by that I mean invested in many different either stocks, if you're looking at a share portfolio, or asset classes at a broader portfolio. If you're not well diversified, you're taking on too much volatility for the level of return you're going to get. You've got to diversify. Otherwise, it's more of a gamble. So you want a diversified portfolio. Conventional wisdom says that around 20 different stocks you'll be effectively completely diversified. It obviously depends on those stocks. If they're all penny stocks, maybe not. But
don't buy 70 miners.
Yeah, exactly. That's right. Exactly. But diversification is important. So you can do it yourself. You can build a share portfolio yourself. Make sure you're diversified. That's a key thing, and make sure you understand what the variability is relative to your time frame. So if you're 7 and you're investing for 2 years, then shares will be volatile. We know that. If you're investing for 10 years, then less so.
Question from Anthony. James, do you use, or how would you use the work of Nassim Taleb in his risk management system into your asset allocation system? And thanks for your time today.
Sorry, the work of who?
Nassim Taleb, the Black Swan guy.
Oh, the Black Swan guy, yeah. So, look, so Black Swan events are obviously a big thing, and in the investment world, there's lots of talk about how you model the tail of the distribution, as we call it. So that's the range of investment returns you might expect. For the large part, it tends to follow a distribution of a particular type. Whether it's a normal or log normal, doesn't matter, but it follows. But the tails are often tricky. They don't fit those distributions very well. To answer the question is, way we do it, well, we use historical data. We go back as far as we can with every asset class. You can get information on the Dow Jones Industrial Average as a proxy for US equity performance, for example, going back to 1900. So it's got every major event in it, including the Great Depression, the Wall Street crash, including the 2 wars, including the 70s recessions, the 83 crash, sorry, the 87 crash, and then the 90 recession and the tech wreck, and it's got everything in there. And we fit our data to that. Are the models perfect? No, they're not. Could there be stuff in the future that it's not reflected in that past data that we're not modeling? Yes, they could. They could. So what we do is we use as much historical data as we can and include as many of those historical events. The past and the future, the future is always going to be different than the past. We know that. Our argument is that, yes, okay, maybe, there are some black swan events that we can't account for, but you're better off modeling what you can than not modeling it at all. So our in the world of financial advice, for example, our main bugbear is that advisors have been giving advice based on average returns. They do a risk profile. They say, okay, you're a moderate investor. Here's what our moderate portfolio looks like. And based on our capital market assumptions, that's a 4.2% return. Now I'm going to model your future at 4.2% every year from age 40 to age 90 and tell you what your future looks like. Our problem with that is that we know it won't be 4.2% every year, even for a moderate portfolio, moderate risk portfolio. It's still going to wobble around. There'll still be some years when it's negative. and the results that they're showing are actually misleading, because you don't get 4.2% each year. It does wobble around, and that does have an impact. Yes, we might miss some black swan events, but our argument is you're still better off trying to model what you can of the variability than just simply ignoring it and modeling an average. So, yeah, thank you. It's a really good question. Thank you for that. We're not perfect. Our models aren't perfect. We're just saying you're better to go to the next step, which is to try and model the variability as best as you can. And that's where we're at. We will continue to try and improve those models to allow for those black swan events, but by definition, they're unknowable. That's what we mean by a black swan event. They're unknowable. And so, it's a tricky one. It's a really good question, but we still think you're better off trying to model the variability regardless.
Yeah, definitely. And also, just because that they occur more often than, than you'd probably expect, that doesn't mean that markets broadly over the long term don't bounce back. And I think that's what your tool makes a very big assumption on, and does that very well. What are your thoughts? Another question: long-term shares or short-term shares? I'm not getting any questions in myself. What do you think? Long-term shares or short-term shares? In other words, invest for the long term or buy to trade, or do both? I think you'll have a good opinion on this one.
I do. And look, this is okay. So this is a very subjective question, and there are reasons why you might argue either way. So my personal philosophy is, having studied a lot of this stuff, is that picking markets is incredibly difficult, and I would argue almost impossible. A lot of studies of fund managers, not necessarily individuals, and we're putting Warren Buffett aside here as being an outlier, and in fact he's not really a market timer. He tends to buy businesses or big chunks of businesses and have a big influence on them rather than just trade. But putting him aside him, because he is he's just an outlier in terms of his performance. But if everyone else, it's very hard to pick markets. So trading is fine, and we need traders because traders make the market. But one of the ironies is that in an efficient market, it's hard to be a trader and make money out of market timing, for example, because the market is efficient. So it's one of those things. If there were no traders, then active traders would come in and make lots of money. When there's lots of traders, it gets harder because the market is made broadly efficient. No one says it's perfectly efficient. So my view is, from my own personal finances, I don't believe I can pick the market any better than the professionals out there who are the BlackRocks of the world and the Vanguards of the world, or any of the active fund managers. I don't believe I can do a better job than that. So I'm a buy and hold person. When I first started working and my money started going into super, I chose my asset allocation before I built Investfit. When I was quite young, I went 100% equities because I knew the principles of it was I was investing for 45 years. Why wouldn't you go 100% equities? And I still am, by the way. 100% equity, balanced between global and Australian. And that was it. I made the decision and I said, that's it. I'm even though my fund allows me to make a switch, I can switch asset allocations as often as I want. There's a buy-sell spread, so I lose a bit of money in that way. But I don't, because I don't believe I can pick the market. That's me personally. And there's plenty of studies that show even active fund managers, professionals, can't outperform the market over any long period of time. Most of your listeners will be way younger than I am. They won't remember the 87 crash, but I remember it partly because that's when my investment exam was on, ironically. But the 87 crash, BT back in those days had forced in Australia, had guessed that the market was overheated, and they switched and they made a big call. And the crash came in October in 87, and most fund managers suffered the falls, and BT didn't. They were the mega stars of the day. They were the heroes. Market timers extraordinaire. And money piled into BT as a result. Ever since then, their performance has been average. I'm not criticizing them. I'm just saying it was a one-off. It's very hard to do that consistently over a length of time. So that's a very long-winded answer. I'm sorry. But my view is, my personal view is buy and hold. Have a strategy. Set the strategy. But the flip side of that is, if you see some opportunities and you think you've got the information available to you, particularly at the smaller end, I guess the micro caps where there's a bit less focus, there may be opportunities for someone doing a lot of research and seeing some underpriced stocks to pick those. But timing the market more generally, I think, is very hard.
Yeah, I think the more I'm the more I'm learning about sort of the makeup of the audience and you know of who typically goes into the market and the kind of information that they need to make a decision, I think generally speaking, I'd probably agree with you that timing the market is hard, and it is a longer term game, especially when it comes to longer term investments. Like, you know, you don't go in and buy and sell houses typically that quickly. There's obviously some reasons for it, but anyway. So tell me something. So one of the questions that we had internally was, do you think it's really possible to determine investing strategy through an app, or do you need to use this along with another with an advisor in play?
Oh, that's a good question. So our view is that for a good chunk of the Australian population whose finances, including myself, are relatively simple, that is, you've got your house, then you've got your super. You may have a bit of money outside of the super, but that's mostly it. And you want to retire you're working and you're going to retire, and you want to have a nice retirement. If that's about it, then I believe technology can do that alone. It needs to be good technology, so it needs a powerful engine that's giving quality advice, and information needs to be presented in a way that is digestible or understandable by most people who are not necessarily finance experts or who aren't finance experts. And I think a lot of that simple advice about what's my investment strategy, you know, what retirement income when can I afford to retire, how long will my money last, will I need to use the equity in my own home, and so on and so forth. I think that those simple questions, or I'm building a share portfolio, what's a good mix of shares, or, you know, that produces an optimal return for my level of risk, and so on. I think that can be done by a good quality piece of technology like ours. I would argue. And in fact, we intend to, and we are building it for self-directed users. At the moment, it's being used by advisors. When your situation's more complex, when you have a family trust structure, for example, or complex tax arrangements, or you want to, for whatever reasons, veer off into more obscure investment types, or getting, you know, investment properties, perhaps, you know, again, they're quite unique in some ways, or you need help managing your debt more. So I think there, an advisor together with this sort of technology is a very powerful combination. So yes, if it's very complex, or if you just need reassurance. So don't forget, advisors often play the role of coach as well as technical advisor. They help you stay on track, and they can remind you to, you know, you agreed you were going to save this much each year. They can keep you hold you to task and say, remember, we talked about that you need to be saving this much a year. So advisors have a very powerful role, in addition to the technical advice, in holding us to account, helping us achieve our goals, reminding us when we're straying, and also things like managing debts and trying to pay down your debt and get out of financial difficulty. So I think there'll always be a role for advice, always. So I think for a section of the community, they will need someone to talk to. And for some people, just like talking to a person. So even though, for example, with medicine, we may well end up in the future with robo medical advice, where a lot of stuff can be done online because they can read your pulse and your temperature, and they can make a diagnosis. And it can be, for simple illnesses, can be automated. A lot of people just get comfort talking to someone. So there's always a value in that human contact for some people. But I think for a big chunk of us, it can be self-directed using quality technology. Absolutely.
We had a poll going at the moment, which really flipped around. Would you consider seeing a financial advisor about your investment strategy? It was overwhelmingly yes at the start. It's now 42% are saying yes, 57% saying no, which is interesting. Maybe your comments have kind of drummed home the value of technology. But like, what are the stats? Like 8 out of 10 people don't use a financial planner in Australia, right?
That's right. So the estimates are 80%, exactly 8 out of 10. Don't use a financial advisor. Now we have to recognise that a portion of that 8 out of 10 really have very few assets at all, sadly. Australia has quite disparate wealth, not as bad as some countries, but there is a chunk of our population who really have very little, and in fact their main need often is managing debt, unfortunately. And so they may see advisors, but not of the financial advice type, more my budget type situation, where they're getting help from someone just managing day-to-day living. So that's a part of the population. So part of the 80 years includes those people. But a big chunk of the 80 don't get advice for a few reasons. And one is they don't trust advisors, and that's unfortunate because there are lots of good advisors out there. But having seen what's been going on and having seen the Royal Commission, there's a lot of people just don't trust advisors. So that's one reason. Another is some people think advice is too expensive. $3,500 up front for your first bit of advice for a comprehensive piece of advice is a lot of money.
Not bad for a bit of fact find and a few questions.
A few questions. So it's a lot of money. It's a lot of money, and you're paying it out. It's hard cash you're paying out now. Having said that, good advice, whether it's delivered by a person or by technology, can massively improve your outcomes. Getting that asset allocation right has been shown to have enormous impact. We can show that in Investfit. The impact can be, you might pay, an advisor $3,000, but they could have impact of $100,000 on your outcomes by getting your strategy right, for example.
I tell you what, I remember looking through Investfit when we were going through a demo, and I was kind of keying in some numbers. I wasn't completely, I was being facetious on some of those, but the net result that ultimately occurred, although they were relatively correct, was actually ridiculous. So the fact that I'm most of my investments, to be fair, I'm very much, I'm not diversified. I'm 100%, in my own business in terms of longer term investments. But having said that, and everything else is in cash. But having said that, it was very eye opening in terms of what I should be doing with the balance of my cash and my self managed super fund, which is to start playing a lot longer, much longer game.
A long game.
Yeah, which was very eye opening. So I think that what's the process for signing up to Investfit? How do you get access? Is it open at the moment to public? Is there something we can do, or is this something that's coming a little bit later?
It's coming a bit later, Ivan. So at the moment it's not open to the public. So advisor, you can go to an advisor who's using it. So our path to market this is probably now as a business rather than as a tool was to get it used by advisors first to prove that it works, and also it's one of those things if the professionals are using it, then we can say great, it's ready for.
And you've got some big clients there as well, like Allianz and
that's it. Mortgage Choice and others. So it is, but our goal has always been to get to the 80% because they need advice. So the thing is, 80% don't go to advisor, and whatever reason they have for not going to advisor. And the other reason I should say, the third reason was, apart from the whole trust and the cost thing, was that some people think, I don't have enough money to make it worthwhile. Well, I'm going to tell you that even if you're super, if you're 40 and you've got even 50 or 100,000 your super, just getting the strategy right on that, and it will accumulate as time goes on. As you put more in, will have an impact on a significant impact on your retirement. So getting that investment strategy right is absolutely critical, and the uplift can be enormous with no extra risk, where risk is defined as a chance that you fail to meet your goals. So you might have a bumpy journey way through, but the end result will be better off. And that's that going back to that series of returns, 1 year, 5 year, 10 year, 20 years that we talked about earlier. So we planned. Our goal was always to get to 80% because we think everyone should benefit from high quality, low cost financial advice, and technology can deliver that. Our advice is high quality. No one in the world yet is doing what we're doing. As far as we know, we're the worst. The first, not the worst. The first in the world.
I think you were talking about the Australian financial ecosystem.
Yeah, that's right. That's right. We're the first to actually do this. So the modeling in Investfit, it models the variability year to year, as I said, in returns for each asset class, or if you're doing stocks for each stock, and then models it over your entire lifetime. And you can choose a level of confidence. So you say, I want to see my results with 90% confidence. That is, I want to show me what I can achieve, what goals I can achieve throughout my life, or if it's just a portfolio in 10 years' time, what can I achieve with 90% chance of getting that result or better? Only a 10% chance of falling short. So getting that right, obviously, is incredibly important. And then, so doing that modeling where we model the variability, and then on top of that, modeling 1,000 different portfolios to find, so we can put hand on heart and say, this is the best one for you personally, given your goals and your particular tolerance for short-term variability and your financial circumstances. That is new and it's complex. So we went to advisors first, and now our goal is now to go to the 80% of Australians who don't get advice, so they get the benefit of that same technology. It's what fund managers use. we're now making it available to the individual and personalized to their particular goals and their particular financial circumstances and their tolerance for variability and their chosen confidence level. All of that's been done in this tool. The challenge is for us to make sure it's easily understood by users who are not strong in financial terms or technically understanding of the concepts. But that's not hard. We're part of the way there. The advisors get it, but they're professionals. But we need to do is just make sure that it's consumable, that people understand it enough to get it and go, yep, I'll actually act on that advice. Because what we want is for people to make the best decisions they can and have the best retirements they can, rather than acting out of fear about volatility, which is what they've been told. Everyone tells them about fear.
I think on that note, James has frozen. Let's give him a second to come back. Unfortunately, on that high note, I know James is back. James, are you back? Well, we get that. If you would like to get access to Investfit, let us know. We can put you on a pre-register list. I think Investfit is in the process of getting launched. Are you back, James?
Sorry about that. I don't know what happened there. It just seemed to drop out. I'll just turn my video back on.
Welcome back.
Thank you.
I feel like you were an important part. Your screen has still frozen, so I think you're having some internet issues while that's happening. But if you do want to get access to Investor, if you want us to let you know when it's ready, type in yes. We'll be able to get that to you. James, is there a pre-registration link anywhere on the Investfit website at the moment?
There's not at the moment, but that's certainly something we can put into play.
Do you have like a general contact email that people can type questions to?
Totally. Yep. Absolutely. So just contact me at james@investfit.com.
Think that didn't come through.
Oh, sorry.
Say that one again, James.
Sorry. Email is james@investfit.io. .io. James@investfit.io.
And I'll just drop that into the chat.
Yeah, perfect. Anytime anyone has any questions, please absolutely feel free to send them through on the topics we've discussed today, or that whole concept generally of investing and portfolio construction.
Unfortunately, this was about the smoothest video call that I've had with you, James. You're out sort of not completely in the city, and it started off a little bit rocky. It finished with now not seeing a camera, but at least we can hear you.
Yes.
Thank you so much for coming on the show. Hopefully next time around we'll get a full sort of 45 minutes in, and we'll definitely want to ask you some more questions. Hopefully when you finally launch, it's an amazing product. I've used it. I need to use it a lot more, I know, and I'm looking forward to your launch ultimately. And I know we'll keep talking in the very coming weeks about broader things. Thank you all for coming. Thank you for making the time, James. I like that as I'm saying this, you're actually popped up.
Back up again. Yeah, I know. It's we've got the NBN, but it just doesn't always seem to work out. Listen, thanks so much, Ivan, for having me on here, and thanks to all the listeners, and for some great questions there too, by the way. Awesome questions. So thank you. I really enjoyed that, and hopefully we can do it again sometime.
Yeah, for next time, I've got a few more that I've got to ask you. Thank you so much for coming.
All right, thanks.